So we're talking about payout policy, and there are different methods. We will talk about earnings per share, retained earnings, dividends, special dividends, and share repurchases. And as usual, I'm going to be using Apple and some other tech companies as our lecture examples. So let's take a look at Apple's income statement, and you'll see at the top of the income statement our total revenues, and Apple has $265 billion of revenues. And then the cost of goods sold or cost of revenue, which is $163 billion, which leaves Apple with a gross profit of $101 billion. Now, out of this gross profit, Apple pays for research and development, selling, general and administrative expenses. That leaves Apple with an operating income of $70.9 billion. Now, they have other expenses, interest expense, tax, and so on and so forth. So their bottom line is that they have a net income of $59 billion. So the issue is actually very straightforward. Any company is formed with partners. People just like you and I, we get together, we form a company, and our purpose is to put down X amount of dollars and generate a return, generate an income. So Apple as a company has shareholders, millions of them, and we pay $190.15 to become a shareholder. And the company, with all the money that it has, the cash, well, let's look at a balance sheet. The cash, investments, receivables, the inventory, the current assets, long-term assets, all the liabilities as a leverage, all of that generates a income statement that looks like this, and then it actually has a net income of $59 billion. Now, that income is our income. We are partners of Apple, and we own this income. So the way that it works then is we take this income and divide it by the number of partners that we have in Apple. So let's take a look at how many shares that they have floating. And let's see. So we have about 4.35 billion shares floating. So what we're going to do is we'll take the 59 or so billion dollar profit and divide it by the number of shares outstanding. And then that gives us our net income per share, or in other words, earnings per share. Now, our earnings per share for Apple is $11.89. Now, the question is, what are we going to do with this $11.89? Keep in mind, this belongs to us. We are the shareholders, and this is our net income per share. So if you hold 10 shares of Apple, you have a right to $118. If you have 1,000 shares, then you have a right for, you have a net income of $1,189. However, this is the income that you own, yes, but the money is still in the company. Company generated this income, and they still have this income on their books. So what are they going to do with it? Well, every year companies get together and with their shareholders, and they decide and take a vote on what they're going to do with the earnings per share or with their net income. They have several choices, and these are referred to as payout policy. What they're going to do with the income is the payout policy. Now, they could choose to do like Google and not pay us anything, not a penny, and keep everything as retained earnings. Now, keep in mind, when a company pays a dividend, it actually comes out of the company, and therefore the price will drop as much as the dividend. Let me repeat that. When a company pays a dividend, the amount of dividend that's paid comes directly out of the company's overall assets, and therefore the stock price will drop as much as the paid dividend. So there is no actual point of paying a dividend to a shareholder. The stock price actually reflects the accumulated earnings per share. So the 11.89 that we own, it's already in the stock price. If the company pays us that 11.89, so let me show it to you on a very simple spreadsheet. So the stock price is 190, was it 15? So stock price is 190.15. Now, if there is a dividend, the complete amount, if they pay 11.89, right, then the new stock price will be this much. Now, overall, so think about it like this. Before the dividend is paid, we have $190.15 of a stock. After the dividend is paid, we now have $11.89 of a cash and $178.26 of a stock. So somehow we actually received cash, but the stock price went down. Some people may prefer this, and some people may prefer that. So if I don't want to receive any dividends and I want to keep my 190 and 15, I don't want a dividend. Google goes this way. Now, Apple and companies like IBM, and there are several companies who likes to pay dividend to their stockholders, to shareholders. Some people prefer that. Now, the problem with the dividend is if you receive a dividend, you pay income tax on it. And people, if you don't need the money, then you may not want to realize that dividend, and therefore you don't want to pay, you may not want to pay a tax on that dividend. So based on the clientele, based on the shareholder appetite, preference, companies choose to pay or not pay a dividend. From a company perspective, paying a dividend or not paying a dividend is irrelevant. Now, there is a dividend theory. So the theory goes like this. If a company has a lot of cash and they have a lot of income and they decide to pay dividend for the first time, it is considered to be a very good sign simply because it is a long-term commitment. And the market takes it as a good sign, and the stock prices probably would increase based on that good sign. Same thing would apply to an increased dividend, that it's a long-term commitment. It actually shows that the company is confident that they're going to be able to generate as much income and therefore pay as much dividends, even ever-growing dividends, and that is considered to be an incredibly positive sign. And on the opposite scale, if the dividend is cut or stopped, then it actually sends a signal to the market that the company cannot pay dividends anymore, and the company is not expecting to have as much earnings in the future, and therefore it's an incredibly bad sign. And based on cutting the dividend or stopping dividend payments, the company's stock price would probably take a dive. So that's usually referred to as the dividend theory. Now, back to the payout policy. The dividend is a payout. The company may choose to pay a dividend, but any dividend that is paid to shareholders is taxable, and therefore the shareholders may or may not prefer it. Now, back to Apple. Google pays no dividends whatsoever. Apple pays some dividend. So, for instance, on this date, May the 10th, they actually paid $3.08. Now, notice earnings per share is $11.89, and they paid $3.08, which means that off this $11.89, they actually kept $8.81 as retained earnings, and they're only paying $3.08. So it is perhaps somewhere in between paying all and paying nothing. They actually pay something. It also shows that they are expecting an increased payment of as at least this much going into future. So perhaps that's a good sign. However, if this dividend is paid, or when this dividend is paid, the investors, shareholders of Apple, will be paying taxes on this income. Now, based on the dividend theory, if a company has good earnings and they want to pay dividends, they know that this is a long-term commitment. And they know that cutting the dividend or stopping the dividend is an incredibly bad sign. So a lot of the times, if they have a unexpected earnings, a sale of a property, some sort of unexpected income that they generated out of an operation, but they generated enough cash that they want to give this back to the shareholders. There's simply no use or no preferred method of investment for the company to keep this cash, and therefore they want to give it out. But they also don't want to send the signal that this is a continuous dividend increase. They just want to make sure that they give you that dividend in one time only, and they basically make sure that they make it very specific announcement that this dividend is one time only and to be paid at whatever the amount, whatever the date is. Now, this is different than the usual dividend that the companies pay or does not pay. So these are referred to as special dividends. Special dividends are one time only, maybe a couple of times. However, they are not expected to continue on a long-term basis, and therefore stopping it does not send that bad signal. Now, if a company has a lot of money, so again, in the case of Apple, let's take a look. Apple has a lot of money. If you look at the balance sheet, you'll see that Apple has quite a lot of cash. So they have $25 billion cash, $40 billion of net investments. And then if you look at the long-term investments, they have $170 billion. So all in all, I mean, I'm not even going to count the property, plant, and equipment. So 170, $40 billion is 210. And then cash and cash equivalents, that's 235, about $236 billion of cash. About $240 billion of cash. Now, notice that this is $240 billion out of $365 billion of total assets. This is quite a lot of money. So think about it like this. We formed a company is generating good amount of income. Their operations are solid. They're generating products and services, and they're selling well. And now they have cash, $240 billion. Now, as a shareholder, I want that money. It's very simple. I really like to have my money. It is my cash, my money. So Apple either can invest this or pay me my money. But the problem is, if they pay that dividend, if they pay that as dividend, then they have to, or investors have to pay taxes on it. And it will come out from the actual company. So if the company is $1 trillion worth, the market capitalization is $1 trillion, and they pay $240 billion in cash, quarter of the company is paid out to shareholders as cash. And based on the discussion that I had here, if a dividend is paid, it is immediately deducted from the stock price, and the stock price will reflect that dividend payment the next day. So if the company pays the entire $240 billion in cash, as a shareholder, I will have to pay income tax on that dividend that I receive, special or not. If I receive it as a dividend, I would have to pay taxes on it. And also, the company's stock price would actually take a dive as much as 25%, since $240 billion is about a quarter of the company. In fact, a little bit more than the quarter of the company as of today's pricing. So about $50 of the stock value would go down. So the Apple stock would go down 150s, and I would have to pay taxes on the income that I received under the name of dividends. So that's not what I want to have. Now, I want to have the money, but I don't want to pay taxes on it. I want to have the money, and I also don't want the stock prices to go down. So I want to have my cake, and I want to eat it too. Is it possible? So they came up with the idea of share repurchases. I mean, it's not a new idea, but the idea is actually quite genius. What they do is they use the cash right here. They use the long-term investments and the short-term investments to buy back stocks that belongs to Apple. So what they're simply doing is, if you remember the number of shares floating or number of shares available for Apple was about 4.6 billion shares right here, shares outstanding 4.6 billion. They will use the $240 billion to buy back number of shares outstanding. So think of it like this. We had a pizza. The pizza was sliced into 4.6 billion pieces. After the repurchase, it's going to be sliced into 3 billion pieces, which means that each shareholder will now own a bigger share in the company. Meaning my ownership in the company, while I don't do anything, I don't buy new shares, I don't change anything, I simply do nothing. But because the company is buying back its own stocks, number of shares outstanding is getting reduced, and therefore what I own in the company will go down. So the share repurchases have two significant impacts. Number one, because the market capitalization is now divided by the number of shares outstanding, which is now smaller, so the denominator gets smaller, value of each share will go up. And number two, knowing this sends a good sign, and everybody will be, with the expectation that the stock price is going to go up, everybody will be buying the stock. And therefore, that expectation alone will increase the stock price. So, in a way, I get rewarded. I still don't receive the cash, so I don't have to pay taxes on it, on my income. However, the stock price goes up, so whenever I like to realize that profit, I can, and I could actually make profit out of it. So the payout policy then starts with earnings per share. We have income divided by number of shareholders. That's your earnings per share. We could retain entire earnings and keep it in the company like Google does. And in which case, the stock price would simply reflect the retained earnings and probably go up. Or we could pay dividends, in which case the stock price would go down as much as the paid dividends. You should be whole as dividend plus the new stock price would be equal to the pre-dividend stock price. And therefore, dividend paying or not paying should be irrelevant. But companies, based on their clientele, some people prefer dividends, and therefore, based on the clientele, may choose to pay dividends. It's quite rare for companies to pay the entire earnings per share as dividends. So they pay some part of it, and whatever is paid is a long-term commitment. And if companies start to pay this for the first time or increase dividends, sends a positive signal. And if companies cut dividends or stop making dividend payments, sends a bad signal. If companies have one-time income and they like to give out dividends for one time and one time only, then they refer to this as a special dividend, just so that investors would know that this is not a committed long-term dividend. Now, if the company likes to pay out, however, they like to pay it out without causing their investors to pay taxes, without actually lowering the stock price, then they may resort to buying their own shares back. Now, share repurchases are very common for the past couple of years. And if I were to do a Google search for Apple share repurchase, you're going to see that, it's just, there are about 1 million results on this. And the first one that I clicked, so Apple revealed $100 billion buyback. They have $250 billion in cash, and so on and so forth. So it's very common. And especially for the last couple of years, companies have been doing this. It also sends a signal that the company believes the stock price is low, that they're reinvesting in their own company. And this actually basically summarizes the entire payout policy. So thank you.